Let's explore where biotech is headed in 2026, looking at the market forces, the money flows, and the curveballs that could change everything. Three forces shape biotech: sentiment, which captures investor confidence; seasonality, the calendar patterns that recur each year; and surprises, the shocks no one sees coming. Late 2024 felt heavy. Biotech was still a trade, not an investment, with M&A talk everywhere, but policy fog keeping everyone cautious. The tape was sluggish, yet investors kept expecting deals to drop any day. A strange mix of doubt and hope. Early 2025 looked more promising. Seasonal trends and improving fundamentals hinted at better odds, even if confidence was still fragile. October usually drags, but November through January tends to lift biotech, thanks to the San Francisco conference buzz, fresh positioning, and more corporate moves. When rates drop or the path gets clearer, long-duration biotech valuations loosen up, and investor appetite starts to return. The first half of 2025 was rough. Headlines and policy shocks overshadowed the science, keeping biotech on edge. January bounced on conference energy and a few FDA wins, but the rally was thin, more tactical relief than real conviction. February brought policy worries. March hit a crisis when the FDA chief resigned. April saw a shaky bounce, and May reignited fears with a controversial regulatory appointment. June finally caught a bid. Short covering and risk-on momentum helped, though it still didn't feel like a lasting turn. By late 2025, biotech wasn't just recovering, it was leading, raising the question, is this real or just another rally that fades? Unlike the wild 2020 run, 2025 was a grind, steady, tested constantly, with investors checking every step for cracks. Summer seasonality feeds fundamental proof points. Earnings improve, medical meetings stack up, and companies deliver the data investors need to stay confident. Biotech often stumbles early in the year, then builds momentum as evidence piles up and catalysts align toward the finish. First quarter struggles, second quarter improves as data arrives, and fourth quarter delivers strength when everything clicks. In 2025, XBI climbed about 34%, IBB rose roughly 27%, and BBC surged around 61%, showing varied returns across biotech funds. The financing window reopened in 2025, letting biotech companies raise serious money again after a tight stretch. Biotech raised nearly $48 billion across almost 700 deals in 2025, the busiest year since 2021, signaling investors were ready to fund risk again. The U.S. led the way, but China showed up strong too. Its biotech scene is now a real force in global capital markets, not just labs. IPOs and follow-ons pull in fresh capital, a clean confidence signal, while rights offerings lean on existing shareholders at a discount, hinting confidence is rebuilding, not fully back. M&A came back to life in 2025, but buyers had the upper hand. Deal volume was solid, yet premiums stayed low. Deals hit roughly $137 billion across over 1,000 transactions. But average premiums dropped to the mid-20s. Steady activity, buyer-friendly terms. Cash-strapped biotechs got pragmatic. Disciplined buyers waited for better prices. And more tuck-ins and early deals compressed premiums across the board. In 2026, the real surprise might be what doesn't happen, especially if the M&A everyone's expecting never shows up on schedule. A quiet January conference week, no big deals announced, could spook risk appetite, shake financing confidence, and make liquidity feel scarcer than it really is. Venture funding looked mixed in 2025. Big late-stage rounds came back, but early-stage dollars stayed tight, with biotech share of startup capital hitting historic lows. For biotech to sustain a real upcycle, venture funding needs to broaden, not just big rounds, but consistent early-stage formation feeding the pipeline. Regulatory volatility isn't just noise. It's baked into biotech's risk premium, shaping how investors value the entire sector. When headlines swing at DHHS, FDA, or CDC, risk premiums rise, valuation multiples compress, and share prices suffer, even when the science stays strong. FDA approvals have stayed fairly strong, yet uncertainty around timing and standards, especially for complex therapies, keeps investors cautious and premiums elevated. 3 policy fights could keep biotech's risk premium high in 2026. Vaccine mandates, drug pricing rules, and manufacturing reshoring, all still unsettled. Vaccine rules vary state by state. Pricing mechanics run on 2 tracks, and reshoring demands drive up costs. Each adds confusion and raises biotech's cost of capital. After a big 2025 rally, you'd expect stretched valuations. But biotech multiples are sitting near their 10-year average, not at extremes. The Nasdaq Biotech Index trades around 4.9 times book value in 2025, right in line with its 10-year average of about 5 times. Middle of the range, not overheated. Price to sales tells the same story, 6.5 times in 2025 versus a 6.6 times average. The rally didn't inflate the sector to a premium. With valuations near mid-band, the next leg up likely comes from execution. Companies delivering results, not just multiple expansion. Looking ahead, biotech's 2026 depends on follow-through, broader venture funding, steadier regulation, and clearer policy rules to keep the re-rating alive.